Yeah, good evening to one and all present here. In our previous sessions, we explored the core emotions in trading, which is fear, greed, overconfidence, hesitation, hope, and regret. And we also discussed how they influence decision making. We also delved into various psychological biases such as recency bias, overconfidence bias, anchoring bias, confirmation bias, herding, and loss aversion. Together, we examined their definitions, the impact they have on trading behavior, and effective strategies to manage them. Today, we will conclude this topic by focusing on fear of missing out, FOMO, the importance of a trading plan, and how Thingsabio helps you in this process. Yeah. So the first one which we are going to discuss is fear of missing out. So fear of missing out or FOMO, it refers to the emotional response traders feel when they fear missing out and potential gains. So it means fear of missing out is an emotional response where traders feel a strong urge to participate in the market due to the fear of missing potential gains. This often happens when markets move rapidly and traders believe they are losing out on opportunities. Causes of FOMO, causes of fear of missing out. So, first one is market volatility. So, rapid price movements, especially during a bull run, create excitement and pressure to act quickly. Traders fear that if they don't act now, they will miss out on significant profits. Social media influence. Social platforms are full of hype about hot stocks or once in a lifetime opportunities. Seeing others share their gains can amplify the pressure to trade impulsively. Hurting behavior and recency bias. So traders often follow the crowd, assuming that if many people are buying, the opportunity must be good. This group mentality can cloud judgment. And recency bias means recency bias leads investors to focus on recent events such as sharp price increases and assume those trends will continue, making them rush into trades. Lack of a clear plan. Without a structured trading strategy, traders are more likely to react emotionally to market movements rather than acting rationally. Impact of FOMO. So this FOMO can lead to poor trading decisions with severe consequences, such as overtrading. I mean, traders enter multiple trades without careful analysis, often increasing transaction costs and exposure to risk. Entering trades too late. So, jumping into a trade after the majority of the price movement has already occurred often results in buying at the top and suffering losses when prices correct. So, ignoring risk management. In the excitement to not miss out, traders may skip using stop loss orders or risk assessment, exposing themselves to significant losses. Loss of capital. Poorly timed and impulsive decisions can erode trading capital, reducing the ability to participate in future opportunities. So, strategies to overcome FOMO. So, first one is stick to a trading plan. A well structured trading plan outlines entry and exit criteria, risk management rules, and position size. Following this plan, we can reduce emotional decision making. Use stop loss orders. By implementing stop loss orders, helps us to manage risk by automatically exiting a trade if the price moves against us, ensuring losses remain manageable. Focus on long term goals. Remind yourself of your broader financial goals and avoid chasing short term market trends that may not align with your strategy. Analyze before acting. Evaluate market conditions and analyze whether a trade aligns with your strategy before making any decisions. Avoid rushing into trades based on hype. Limit social media influence. We need to reduce time spent on social media platforms that promote fear and greed. Focus instead of credible sources of information like Bloomberg, Barron's, and market analysis. Learn to accept market opportunities, missed opportunities. Understand that it's impossible to capture every market move. Missing an opportunity is better than risking capital on an unplanned trade. So basically, this FOMO means fear. In the word itself, there is a meaning. FOMO, fear of missing out. So, by the fear of missing out an opportunity or profitable trade, we may, we may enter into the trade. Without proper planning. So, by this, what are the impact it will have? What are the causes it will have? And what is the impact of this FOMO and how to overcome this FOMO? And then we have the importance of a trading plan.
Three books. The first one is The Lords of Eden. By the end of it, you're gonna be so pissed. You're gonna start making money because you're gonna understand how it works. The second one is The Millionaire Master Plan. It's understanding what is your wealth profile. Different people make money in different ways. People are looking at stock traders or at investors, like, I wish I could do that. But it's complicated. Well, maybe it's not your wealth profile. Maybe you're trying to get rich at the wrong thing. And finally, the one I always recommend to people, inside of the Bible, there's a book known as Proverbs. It's 31 chapters. You can read one chapter every single day. It takes you about 5 minutes. Transcendental, unchanging, forever wisdom that can be applied to anybody, regardless of
I
religion.
mean,
I'm on a raise. Add 30% to your offer. No, add
yeah. Next, the importance of a trading plan. So, a trading plan is a set of rules and guidelines that define how you will enter and exit trades, manage risk, and achieve consistent profitability. So, a trading plan is a structured set of rules and guidelines that dictate how traders approach the market. It defines when to enter and exit trades, how to manage risk effectively, how to aim for consistent profitability over time. The trading plan acts as a blueprint for decision making, helping traders stay disciplined and avoid emotional or impulsive actions. So, components of a good trading plan. So, first of all, does why is a trading plan important? Because this trading plan will eliminate emotional decision making. Like markets are unpredictable, and emotions like fear and greed can cloud judgment. A plan ensures you to follow predefined rules instead of making impulsive decisions. And this trading plan can promote consistency. Following a plan allows traders to build a consistent approach, which is critical for long-term success. Consistency reduces random outcomes and improves overall performance. This trading plan can improve risk management. A plan includes guidelines or controlling losses, ensures that no single trade can harm your overall portfolio significantly. And this trading plan can provide clarity. A well documented plan removes guesswork, helping traders focus on executing their strategies without second guessing their decisions. So, what are the components of a good trading plan? First is entry and exit rules. So these rules specify when to buy or sell a stock, ensuring trades are based on clear criteria rather than emotions. I mean here entry rule define the condition that must be met before you enter a trade. Example, we only buy a stock we only buy a stock when a stock breaks above its resistance level with high volume. So exit rule. I mean here exit rule outline when to close a trade either to lock in profits or cut losses. For example, we exit when the price hits a predefined target or falls below a stop loss level. So why does this matter? So these rules prevent you from chasing trades or holding on to losing positions for too long. Second one is risk management strategies. So this risk management ensures you protect your capital and stay in the game long enough to see long-term gains. And key elements, there are some key elements of risk management, which is position sizing, stop loss orders, and diversification, which we will dive into later. And why does this risk management strategy matter? I mean, without proper risk management, even a few bad trades can wipe out our portfolio, complete portfolio. And targeted reward to risk ratio. So this ratio measures how much you stand to gain compared to how much you are risking on a trade. So normally we have a reward to risk ratio formula. Like for example, we aim for a 2:1 ratio, meaning I am willing to risk $1 to take a profit of to make $2. So why does this matter? Focusing on favorable reward to risk ratios ensures that even if I lose more trades than I win, my overall profitability remains intact. So first of all, entry and exit rules. So what are these entry and exit rules? Entry and exit rules are essential components of a trading plan. They provide specific objective criteria to help traders decide when to enter or exit a trade. These rules prevent impulsive decisions, ensure consistency, and reduce emotional involvement in trading. So entry rules. Entry rules define the conditions under which you will initiate a trade. These conditions are based on thorough analysis and ensure you only take positions when the odds are in your favor. So, common entry criteria, technical indicators. So, we need to use tools like moving averages, relative strength index, or moving averages, convergence, divergence, or MACD to identify entry points. For example, we need to enter a trade when the stock prices crosses above its 50-day moving average with high trading volume. So it is an example. Next, chart patterns. Look for patterns like breakouts, double bottoms, or head and shoulders as signals for entry. Like for example, we need to buy when the stocks breaks out of a resistance level. Fundamental analysis. So we need to focus on strong financial performance, positive news, or earnings reports as potential entry signals. For example, we need to enter a trade after a company reports better than expected quarterly results. So this importance of a entry rule is it prevents chasing trades based on emotions or market hype, and it ensures the enter trades with a clear rationale and favorable conditions. Exit rules. Exit rules determine when you will close a trade, either to secure profits or to limit losses. These rules help avoid holding positions too long or exiting prematurely. And there are two types of exit rules. One is profit taking rules. I mean, here we can define price targets where you will sell to lock in gains. For example, we will sell the stock when the stock price reaches a 10% gain from our entry point and cutting losses or stop loss rules. I mean, it's set predetermined levels where you will exit a trade to cut losses. For example, we will sell if the stock price falls 5% below our entry point. So common exit strategies: traveling stop loss, trailing stop loss. I mean, we can adjust the stop loss level as the price moves in our favor to protect the gains. Indicator based exit. I mean, we can use indicators like the 200-day moving average or RSI, which is relative strength index, to signal when to exit. And what is the importance of these exit rules? It can protect our capital by cutting losses early. It ensures we lock in profits without being greedy or overexposed. For example, uh, for example, let's think like okay, let's think like I'm buying a stock when the current price crosses above the 50-day moving average, indicating bullish momentum, and and I can sell. I mean, I can take profit if the price rises 15% above my entry point, or it drops when it drops below the 200-day moving average. So what will be the outcome, final outcome? So this structured approach ensures that I don't hold on to the stock too long, reducing risk and securing gains. And then risk management strategies. So in this risk management strategies, we have position sizing, stop loss orders, and diversification. So position sizing means we have to only allocate a small percentage of our portfolio to any single trade, like 1 to 2%. Stop loss orders. We need to set automatic levels to exit a trade if the price moves against you. Like for example, exit if a stock drops 5% below our entry price. Diversification. So avoid putting all our capital into a single stock or sector. We need to spread our investments across different assets or sectors to reduce risk. So without proper risk management, even a few bad trades can wipe out our entire portfolio. So what is this targeted reward to risk ratio? The reward to risk ratio is a key concept in trading and investing that measures the potential profit of a trade relative to the risk we take. For every dollar you risk, it shows how much you stand to gain. And the formula to this reward to risk ratio is potential profit divided by potential losses. I mean, for example, if you expect to gain $200 on a trade and are willing to risk $100, then the reward to risk ratio is $200 divided by $100, and that is equal to 2:1. So why is the reward to risk ratio important? It improves profitability. A higher reward to risk ratio means that even some trades or losses, you can still achieve overall profitability. Like for example, if you win 40% of your trades with a 2:1 ratio, you can still make money because your winnings compensate your losings. So it encourages this reward to risk ratio, it encourages discipline. The ratio ensures traders evaluate the potential rewards and risk of every trade, discouraging impulsive decisions. Risk control. By focusing on favorable ratios, we can avoid taking trades where the potential loss outweighs the potential gain. And how to choose a reward to risk ratio? I mean, many traders aim for a minimum of 2:1 or higher, meaning they aim to gain $2 for every $1 risk. Adjust based on strategy. Like, if you are doing a short term trading, if you are doing a trading for short term, we need to aim, our ratios can be our ratios can be aimed closer to 1.5 is to 1 or 2 is to 1 due to smaller price movements. But when we are aiming for a long term, these ratios can be higher, such as 3 is to 1 or 4 is to 1, because of larger potential gains. And why does this reward to risk ratio matters? I mean, profitability. A positive reward to risk ratio ensures profitability with the losing trades. Like even if half of our trades result in losses, a positive reward to risk ratio ensures you are still profitable overall. Like for example, with a 2 is to 1 ratio, winning 50% of trades means we had won 10 trades. I mean, if we had done 10 trades, I mean, we had done completely 10 trades, and in the 10 trades, my reward to risk ratio of 2 is to 1, my success percentage is 50%. So what does this 50% means? I had won five trades out of 10 trades. So if I assume $10 profit for every win, so here I am getting a profit of $50. Whereas 5 loss, I mean when I have 5 wins and the remaining out of 10 trades, if my half of the trades are incurred in losses, so let's say I had I mean I had included the stop loss order. If I assume the stop loss order will be $5 for each trade, so for 5 trades, my stop loss order will become $25. Whereas the profit on one side is $50 on 5 trades. On every trade, I had made a profit of $10, so which is $50. And on the loss side, I had made a loss of $25. So when I see overall, my profit will be still $25. So here the content is, even okay, it's impossible to win every time. So but still, even if we are even if we lose sometimes, when we see the overall perspective, we can still be on profits. Like we need to focus on quality here. We are encouraged to analyze trades carefully and avoid setups with poor reward to risk ratios. I mean, here we need to concentrate on quality more than quantity. And finally, uh, how Thingsabio and finally how Thingsabio helps you in this process. How Thingsabio can stand out by helping you in this process. Like we have various reports and tools. Like in My Universe section, in our website, there is a My Universe section which allows you to create virtual portfolios and test trading strategies without risking real capital. Comprehensive rewards. There are so many reports available in Thingsabio website. Like Thingsabio's, it includes which includes moving averages, forecast reports, insider transactions, institutional activity. These tools enable you to make calculated decisions. like institutional insights. There are many, the our Things Hub Your platform can deep dive into institutional trends that helps you align your trades with the smart money, reducing the guesswork in planning your trades and trading. And Things Hub You finally, community support in our website. There are, our website provides many Telegram groups where an email facility where we can ask our support. Where we can we can ask our problems. And finally, educational content, like uh, in our Think Sabya website, there is a session called Think Sabya University. In that we have some education sessions on how to do stocks, how to do options, how to invest in crypto, and additionally we have YouTube channel with the name Think Sabya, and in that Think Sabya we had many educational content on various topics. So yes. So finally, this session, trading in psychology, defines like, we need to act. We have to avoid emotional decision making. We need to avoid emotional trading, and we need to trade everything with logic. Even in the sense, we can concentrate on more on quality rather than quantity. Is anyone have any doubts?